A very good morning and welcome to one and all. Trust you all are doing well and taking care amidst heavy rains in several cities. I am Aditi Pathak. I lead the ISA Academy initiative at Customized Energy Solutions and also assist with the power trading and sustainability services. I will briefly introduce about us, introduce our esteemed panelists for today, and will hand over to Nikhil and Mr. Anil for a wonderful discussion ahead. Sustainability and power trading services at Customized Energy Solutions India were launched in 2012. We are a CERC approved trading licensee. We provide various services such as end-to-end electricity portfolio management, bilateral energy trading, IREC trading facilitation, RE integration assistance, energy storage solutions, leadership trainings for ESG, and policy advocacy. ISA Academy is an initiative at CES which was founded to carry out workforce empowerment projects for energy storage, e-mobility, green hydrogen, and renewable energy segments. We deliver scheduled trainings, corporate trainings which are tailored to specific requirements, and we also support e-learning through our own learning management system. We also host various events such as webinars, roundtables, and discussion forums, which deliver an essence of insightful information for our industry colleagues in energy sector. So this VAT-hour forum that we have formed at ISA Academy is conducting its 7th webinar of 2025 today on decoding electricity derivatives in India. We have invited industry expert in the segment to lead our discussion. We welcome Mr. Anil Kahe, who is the Senior Manager, Strategy and Product Development at Power Exchange India Limited. He is a mechanical engineer from Osmania University, Hyderabad, and has also done MBA from National Power Training Institute, popularly known as NPTI. He brings with him wealth of over 21 years of experience across various facets of the power sector, like regulatory policy, assistance in tariff-based competitive bidding, investments, project control, and manufacturing. He has worked extensively in the services and manufacturing sectors with ICRA, CRISIL, GMDC, and DLF Power. At Pixel, Mr. Kai is responsible for formulating and implementing strategy and helping devise products that both meet and anticipate the needs of the market participants. It is a pleasure to have you, Mr. Anil. Welcome to the forum. I will now hand over to my colleague Nikhil Sauganskar, but just 2 words about him before that. He'll be moderating the session. He is the Associate Director for Power Trading and Sustainability Services at Customized Energy Solutions. With over 16 years of experience in the power sector, he specializes in metering, power trading, which includes exchange-based transactions and trading of renewable energy certificates, regulatory compliance, and helping clients with end-to-end hand-holding for renewable energy transition. Over to you, Nikhil. We look forward to a wonderful, engaging discussion. Thank you.
Thanks, Aditi. And before we start, just a minor correction in the introduction of Anil sir. So he is heading strategy and product development at PXIL. He's vice president of his department. So thank you, Anil sir, for your time. And it's a privilege to have you on the panel. And as we typically do, we have done in the past 6 sessions, I typically set the context, we introduce the topic, and then we initiate the discussion. Today, there is a little change given this is a very new market and a segment that we are talking about, but I would really like to take 1 or 2 minutes to set the context with this slide, which is a very basic one. And, idea is just to bring to the table who are our stakeholders that we are talking about, who will be affected or who will get an opportunity from this segment, and how what should be individual perspective, so to say, for these segments. So we have broadly, this is an outline of India's power sector framework. We have generating companies, we have transmission companies, we have distribution companies, and apart from that, the end consumer, of course, who may be a HC consumer, a residential consumer, agricultural consumer, and what other categories are there. We have generation, which is delicensed. We have generating companies producing power from thermal sources, hydro sources, or renewable energy sources. We have transmission companies, again, who are state or central owned. In generation companies also, we have private companies as well as state government companies, central government companies. And again, discoms, while some of the areas have seen the privatization of the discoms, mostly this is a monopoly business dominated by the state-run discoms, who has the obligation to serve the end mile consumers, and to monitor all these aspects, and they function well within the framework of the law. We have regulatory authorities. We have CERC, which monitors the central level regulatory aspects, and we have state and UT level regulators who control these overall regulatory aspects of this entire ecosystem. And then to monitor the flow of electrons in line with our capacities, we have grid operators. So we have regional level grid operators, state level, and a national level grid operators. Now, the missing part or the picture that is not here is the role of power exchanges, because they facilitate the sale and purchase of power on short-term basis so far. And now there's another aspect coming into picture, the financial contracts. So while this is a stakeholder mapping, every individual's risk management perspective is different. Discom is a highly regulated business where for every actions they have to go to regulator and take approvals to run their business. For generators, it is mostly driven by their investors and overall expectations from that investment into their generating assets. And the end consumer, they have a lot of different level of expectations because their benchmarks are different. So with this context, I think the today's topic that derivatives have got introduced in India markets, and how exactly we see these opportunities unfolding for stakeholders, different stakeholders, and how they can make most of it. So thank you, Anil sir, for your presence, and I'll hand over the forum for your opening remarks and to take through us about these products that have been introduced. Thank you.
Yeah, thanks, Nikhil. I hope I'm audible.
Yes, you are, sir. I'm
Yeah.
just trying to stop the screen.
Yes, thanks to IESA and Customized Energy Solution for inviting me to this webinar series conducted by WATR. I suppose this is session 7 and it is titled as Decoding Electricity Derivatives in India. It's too early for me to speak on electricity derivatives because primarily I am with the power exchange, and this power exchange has been promoted by NSE, and NSE has introduced the electricity derivatives. As Nikhil has earlier in the brief introduction regarding the electricity industry structure has spoken about different grid connected entities, the transactions that may undertake, and how the stakeholders of the sector, so whether it is policymakers, regulators, or the load dispatchers. Okay. Now, when it comes to load dispatcher, you do have 3 different elements. One is the NLDC when it comes to the collective transactions. You have the RLDCs who take care of interstate bilateral. Now, this bilateral could be through the exchange or it can also be through the trading entities, trading licenses per se, and also the SLDCs at the state who are responsible for intrastate transactions. Now, the electricity industry has all these elements. When we say elements, it could be entities who could be buyers and sellers. And when we say buyers and sellers, primarily from the power exchange perspective, when I say buyer, it is someone who is drawing power to meet his power requirement. And when we say seller, it is someone who is selling power to meet his power trading or revenue option, to the extent that during any given time block, the selling entity could be a discom who has some surplus power and it would like to make best opportunity of whatever revenue proposition is available in such type of markets. Now, in all these transactions that we undertake, primarily it is physical transaction wherein you trade what is the megawatt that you either intend to buy or sell during a particular time block, and what is the price at which you have concluded this transaction. Now, this transaction which has been entered into can be for any type of power. And when we say any type of power, since on the power exchanges you have exclusive contracts for trading either in the conventional, when we say conventional, it can also be bundled power, but you do have exclusive electron-based contract, which is either a green electron. So the source or the selling entity would be any of the renewable based plants, solar, wind, hydro, small hydro, cogen, or maybe waste to heat. And similarly, you also have high price segment where the regulators have approved and power exchanges also have introduced exclusive contracts for 100% imported based plant, liquefied LNG based plant or an naphtha based plant, or even the BESS, which are allowed to sell under the high price segment. So all these grid connected entities, when they are transacting in power for a specific time block, irrespective of type of power that is being traded, everyone is keen to hedge whatever is the price that is associated with this transaction. So when we say hedge, it is primarily for an entity which is purchasing power on the power exchange platform. And if we consider the case that on power exchange platform, you now have term ahead contracts where you can trade up to 3 months ahead. So today on 20th of August, I can actually purchase power for the month of November also. And similarly, someone who is selling electricity can as well trade electricity or sell electricity for up to November month. Now, when he is entering into a contract for either purchasing or selling power for future periods, or maybe even the day ahead market also, he is at the current moment trying to assure the quantum that he can either sell or procure. Why? Because he would not like to be exposed to volatility that may exist. And when we say volatility, it could be, in case of buying entities, it could be the ceiling price of rupees 10, which is what every discom would like to avoid. Similarly, when someone is selling power, and if it is exposed to the day ahead market volatility, it could also be a case that you could be exposed to prices much below maybe 1 rupee for few time blocks in a day. Okay. And then how do you structure your contract? Whether you want to expose yourself to such volatility or you would like to assure the quantum under the term ahead market contracts and then secure the price. So when we secure the price, you require an instrument. Now such instruments are available in the equity and commodity exchanges. Now when we introduce this on the electricity, you term it as the electricity derivatives. So primarily as an understanding to start with, someone who has entered a contract, he would like to secure his electricity. At what price he is securing. So that's how the electricity segment comes in. I hope this should be okay for the introductory part.
Yeah, sure, sir. While the background is really crisp and clear, that why somebody needs these contracts to be in place. Uh, can you please help us understand how exactly the broader features, maybe if these electricity
I have a short presentation of couple of slides. Okay.
Sure.
I'll
Sure.
just run through what is the electricity derivative contract. Okay.
Yeah.
And that would help everyone in
Correct.
this specific journey of understanding what is electricity futures and how anyone and everyone of us can benefit from that.
Sure.
I'll just upload the presentation.
Sure, sir.
Now, this presentation is a standard presentation which we have adopted from NSE because it is National Stock Exchange which has introduced the electricity derivatives contract.
Yeah.
And just to run through a brief of that, as everyone of you is aware, you have three segments: generation, transmission, distribution. Trading per se is handled either by the generating companies who want to sell, or it is on the other side, entities which want to buy, which is primarily your distribution companies, discoms who want to sell their end consumers, or it could be retail normal C&I consumers who are looking to purchase maybe as an alternate power, or maybe sourcing is for some few periods of time or few periods of a day to meet their power purchase requirements. And then electricity has its own complexities. There are technical aspects related to that. There are commercial aspects related to that. You do have physics of power, which is primarily Kirchhoff's law. So what I interpret from Kirchhoff's law is basically electricity flows through displacement. So it has nothing to do with contract part. It is displacement. So any buying entity is actually served under the wire network from the nearest source from which power is being obtained. So any electron that is coming into a meter of a consuming entity is coming from the nearest source. So that's how it is. And other aspect, when it comes to commercial aspects, is basically electricity cannot be sourced. So when it cannot be sourced, it needs to be generated when there is a demand. And when it is being generated, you need to have a price for which this transaction can happen. And since electricity flows at the speed of light, so you cannot actually have a real-time price, whereas you can have a price that is applicable for that 15-minute time block. And that plays a crucial role regarding how do I secure my futures. To get into specifics of how derivatives are, as everyone was aware, all these days, or when we say all these days, I am referring to 14th of July. From 14th of July, you have had electricity futures introduced by NSE. So prior to 14th of July, any selling entity would look at contracting power maybe under long term, maybe at short term under bilateral exchange market, or do a merchant sale where it could be on day-ahead basis or real time. Similarly, for a discom or any other buying entity, it could be your standard PPA. Similarly, engage a trader or purchase a power. In none of these transactions prior to July 14th, when or prior to introduction of derivatives, you could actually hedge the price at which any contract is being executed. And this is what is the necessity which is now been fulfilled by NSE under the electricity. And when we come into the specifics of how this contract is entered, I understand many of us are exposed to general contract specification which are applicable for physical trading of power, where you have general terms and conditions like which is the buying entity, which is the selling entity, what is the type of power that I can sell, what is the quantum at which I can sell, what is the price that is applicable, and then what are the margin and settlement requirements that are applicable. Similarly, when it comes to electricity futures also, they have a standard contract specification. Why? Because electricity derivative is a standardized contract that gets settled at a specific date and time. Okay. Now, when we come to specific date and time, let us get into more deeper. Currently, the electricity derivatives that are introduced, they are available for up to 3 months ahead and existing month. Now, this co-terminus is taken from the fact that on the power exchanges, you can trade power up to 4 months ahead or up to 3 months ahead. So in the month of August, you can actually trade power up to November. So similarly, in the electricity futures also, whatever contract you have traded, that can be hedged for 4 months ahead. So today, I am having electricity futures for trading for the month of August and also trading available for November month. So it's a 4 month. Now the commodity exchanges operate from 5 days in a week. So it's typically Monday to Friday. Trading in electricity futures happens from 9 a.m. to 11:30 a.m., which is 11:30 p.m., which is equivalent to whatever is the other commodities that are getting traded. And then in addition to this, when we come into specifics of how it needs to be traded, primarily they have concepts like lots. In the electricity, in the physical trading of electricity, if it is buying, you do have SERC's regulation saying that up to 1 megawatt. In few states, it is less than 1 megawatt and up to 500 kilowatt. That is what is the eligible quantity. And on the cell side, it is at least up to 100 kilowatt for a RE based generator, which under the green open access rules. Similarly, when it comes to trading of electricity futures, there is a concept called lot size, which is 50 megawatt hour. So 50 megawatt hour or 50,000 units of electricity is the lot size that is applicable. And you also have a tick size that for every lot, if I want to change the price, what is the price that is applicable? It is rupees 1 per megawatt hour. Now this tick size of rupees 1 per megawatt is equivalent to whatever is the terminology that is used in the physical segment. And similarly, you have concepts like what is the maximum order size, which is 50 times trading unit or 50,000 megawatt hour or 50,000 units of electricity. So this is what are 2,500 megawatt hours of electricity that can be traded in a one single order lot. So you have concepts like minimum order quantity, which is 50 megawatts, or one trading lot can be 50 megawatt hour, and tick size will be rupees 1, and maximum order size can be 50 times a trade. Any entity can place as many number of orders. However, what we presume is, since this is an instrument to hedge the cost, so it is primarily the buying and selling entities, grid connected entities would be hedging whatever is the traded quantum. And then you have daily price limits, which is up to 9%. Now, this is as per the SEBI's circular, wherein anything, the moment it crosses 9%, there will be circuit filters which will come in. There is initial margin of 10%, which everyone needs to submit. In addition, there could be additional margin which could be prescribed based on volatility. And then you have concepts like what is the maximum position that any entity can take. Any individual entity is allowed to have an open position of not more than 3 lakh megawatt hour or 5% of market wide position. And a member who is trading on behalf of, collectively on behalf of different clients, will have 30 lakh megawatt hour as the maximum quantum. You also have daily settlement limit. So on daily basis, whatever futures contract that you are into do, there will be a settlement based on change that happens between yesterday's price and today's price. And this daily settlement price would be weighted average of transactions that take place during the last 30 minutes of the day. And then you have the final settlement price. Now, the significance of final settlement price is the contract that is introduced is the monthly futures contract. So, in a monthly futures contract, what happens is the contract will necessarily go for expiry at the end of the month. Now, in this case, since the month is maybe of 30 days or 31 days, so at the end of the month, every monthly futures contract will have a specific price, which they called it as the due date rate or the DDR rate. And this would be a cash settle contract. So when we say cash settle contract, there is no physical trading of power that will happen between buying entity and selling entity. It will be only the financial settlement which will happen. And how this financial settlement happens is primarily what NSE has done is they have arrived at a daily weighted average price. So on daily basis, NSE computes the weighted volume average price by considering the three segments, which is your green, conventional, high price, and from all the three exchanges, identify what is the weighted volume average price for each day. So on daily basis, the PXIL as the power exchange shares this information with NSE, and then at the end of the month to arrive at the DDR price, the simple average is taken. So this is how the eventual trading or the contract structure related to the electricity derivatives is happening. So this is a brief which I can which I have shared, and hopefully we can move on now.
Right, sir. Thank you. I think this clears a lot of ambiguities that audience might be having with the structure of the derivatives, and maybe we can start with few questions. Let's start with something to for clarification for the purpose of audience. My first question, and of course it may have yes or no answer, but would expect little more. Is it necessary for a participant to transact in a physical delivery segment like DAM or GDAM after they take position in futures?
Yes, to answer this query, let us accept the fact that this is a derivative, okay, and the derivative instruments are primarily to hedge against whatever is the physical transaction that you have undertaken, okay. So for any entity which is trading in power, so when we say trading in power, primarily a generator is selling power in a market. Similarly, a DISCOM is buying power in a market. Now, when I say market, I'll refer to either power exchange market or bilateral. And also the commercial and industrial consumers who are the open access consumers, they are also purchasing power. Now, whatever is the cost at which they have transacted power for physical flow of power, okay, they would like to hedge. So when we say they would like to hedge, they would like to understand what is the quantum that is applicable. So what we say or what NSE says to everyone is, since the lot is 50 megawatt hour, so if someone is actually trading power for 50 megawatt hour, so he should hedge for that one lot. If he is trading for 100 megawatt hour, he can hedge for two lots. So you hedge to equivalent quantum of electricity that you have traded. Anything above that is not hedging. Anything above that is not hedging. So for any grid connected entity, he has to hedge to the extent he is trading in physical power. So only then it acts as a hedging instrument. And why? Because the electricity future is a standardized and it's a cash settled. Okay. So because physical power is already trading in your market, but since it is cash settled, the participant is allowed to fix the price for future delivery period. Okay. And as a hedge against that instrument.
Sure.
So that is the limited submission that we will make at this stage, that it is primarily a hedging instrument, and you hedge to the quantity that you have physically traded.
Sure. But in that case, sir, help us clarify because I think the contract specs allow non-participants also to participate, right? While it is an advised thing that you need to take position there after participation in futures, but in
See,
derivative.
there is to start with, there is no bar. There is no
Yeah.
bar on any entity to trade in electricity futures. Okay.
Yeah.
There is no bar. So when I say no bar, so what it means is irrespective of physical quantum that you have that is exposed to the market in the sense it could be power exchange market or short-term market of up to 1 year, maybe through deep bidding, maybe through traders as an OTC. Okay.
Yeah.
There is no bar to have a like-to-like hedge.
Yeah.
Any entity can take any position. So there is no bar on that. It is up to the entity to decide. But however, since it is a pure hedge instrument, we expect all grid connect entities to hedge whatever is the quantum that they are trading in the physical market.
Sure, sure. I think that clarifies and I'll repeat it just for the.
But there is no bar.
There is
There
no
is
bar.
no
Yeah.
bar.
Yes.
Yeah.
And yeah, I think that really helps. And sir, coming to a little hypothetical question that as we discussed during context setting, price risk and perspective of each stakeholder towards that risk is different. So for example, as you rightly said, for discoms, if they are taking some positions in physical markets like DAM or GDAM, they would like to hedge their risk against that trade. Whereas for C&I consumer, especially now who are more encouraged towards renewable energy contracts on long-term basis, their hedging expectations are different because their volatilities are different. So how this segment you feel that has the potential to grow and really provide some opportunity for every individual stakeholders, to meet their perspectives or meet their hedging expectations on this platform.
Yes. So when we say who could be the participant who can benefit, okay, under the electricity derivatives, you can have generators, you can have discoms, you can have all RE based plants, you can have all the industrial users. So when we say industrial users, it could be multiple industrial units who can benefit from purchasing power. It could be traders, it could also be retail consumers. Now the retail consumer and traders is taken from the fact, or the industrial user is taken from the fact that today let us accept the fact that the retail tariff that is issued by any discom to a consumer is based on whatever is approved by the SCRCs. But however, it is not a fixed number that comes in, maybe as part of the fixed charge. Fixed charge could be a fixed number, but however, when it comes to the energy charge that is charged, maybe in terms of kWh or in terms of kVAh that is charged, the monthly rates varies from month to month. And why it varies from month to month for any retail consumer is, when you say retail consumer, a consumer who is receiving power from discom, is because there are different energy charge or fuel charge related elements that get approved from time to time. Now, this approval that comes from time to time is basically approved to recover from consumers, maybe not at one go, it could be in multiple installments, and multiple elements can be part of the recovery. So when such is the regulatory regime, wherein the retail distribution licensee is allowed to recover different costs at different points in time during a month. So what it means is, for any retail consumer, it is not a fixed rate fixed per unit rate of billing that is happening in addition to the fixed charge. The whatever units that you consume is also subject to variable charges. Now, this variable charge that varies from month to month can actually be hedged as a power purchase cost by the C&I consumer by purchasing futures. Okay. So even for a retail consumer, even he can also purchase these futures and hedge whatever is the power purchase cost. So this is the limited suffrage.
Sure. And I would like to ask the question that is really might be close to your heart, but from your as a person who has been working with product development segment for a long time, and from that perspective, how do you see striking a right balance between encouraging this innovation and protecting smaller participants from these undue risks, which might be possible? I'm sure there are some mechanisms already inbuilt in the product segment. If you can throw some light about it, that how someone can
Yeah.
really protect themselves. Yeah.
When we say smaller segments, what at least as a derivative product that we can refer to is the retail consumers. Okay, your C&I consumers. No,
Yeah.
and why we say C&Is and not household consumers is because if you want to hedge in electricity futures, the minimum lot is 50 megawatt hour. So when I say 50 megawatt hour, it is 50,000 units. And since it is a monthly contract, okay, the equivalent number of units for which I can hedge in terms of physical is the monthly bill that I receive. Now, if any entity has a monthly bill of about 50,000 units, okay, and if we consider that generally the so-called production factor or utilization factor is about 85% in a month, depending on whatever equipments run. So any industrial unit or a commercial unit or a commercial meter that has unit consumption of at least 70 kilowatts, okay, will necessarily have electricity consumption of 50,000 units. Now this 50,000 units will make him eligible to hedge at the minimum traded quantity of 50 megawatt, and hence such entities can actually hedge on the power purchase cost for futures in the futures market. So this is the minimum that we can expect. Now when we say 50,000 units or 50 megawatt hour, any mall, any industrial establishment that has 70 kilowatts of load, any hotel, necessarily it will surely, all these such entities will surely have connected load which is more than 50 kVA. So they can actually become natural hedgers in this market. You may not be having open access to purchase power. However, since the electricity per unit rate varies from month to month, they can become natural hedgers in the electricity futures market.
Sure. And sir, any inbuilt mechanism wherein such consumers or such participants can be protected from the price risk that are coming from these? Because we have to accept the fact that you may lose, you may be able to hedge your price risk from these segments. So any protections that have been inbuilt in the contract that, okay, this is the limit, somebody has taken this position, and prices on the physical market have suddenly fallen or gone really high, to protect the participants from these undue risks? Is there any?
Yes, to address this query, whether there are price limits or not,
Yeah.
except for the futures trading price, okay, there is no specific limits which are applicable for any entity. But however, since this is a electricity futures contract that is reference to the daily market price, okay, when it comes to NSE's monthly futures contract, it is referring to a weighted volume average price for three segments. One is your green segment, second one is commercial segment and high price segment, and it is considering across all three platforms. So since all three platforms discover prices in all three segments, okay, so they have taken a weighted volume average price. Now, as everyone is aware that depending on the demand supply situation, the day-to-day price varies. Okay. So if day-to-day price varies, then what is it that a buyer or seller needs to do? If a buyer is purchasing power on the physical on the physical market or the power exchange market, he will purchase electricity futures. And the terminology used is he will use a long position. Okay. Now, why is someone purchasing futures? Someone is purchasing futures because he expects price to rise in future. So when I say price to rise in future, like today we are placed in on 20th of August, there is some day-ahead market price, weighted volume average price, which is available. If someone is purchasing power for the month of September and he expects prices to increase, then what happens is he will be purchasing a futures price at a specific price. Like today, if the price is 4 rupees, if the weighted volume average price is few rupees, he anticipates demand to increase and he purchases futures contract at 4,500 per megawatt hour or 4 rupees 50 paisa per unit. But however, at the end of the month, I'm saying end of the month, when we say it is September 30, at the end of the month, if the DDR or due date rate is 5 rupees, okay, he gains the 500 megawatt hour or 50 paisa in the futures market. So that is how he is protecting himself from the physical trading, because when he is buying power, yes, he has entered into this contract, but what gets delivered is at 5 rupees. Similarly, if the price drops, there will be loss in case of a buyer. So on the other hand, for a seller, if he enters into a futures contract, and if there is an increase in price, then he loses in the futures market. So this same seller, if he had purchased at 4 rupees, 4 rupees, and if prices increases, he is losing in the futures market. So he has taken a short position, he loses. So the similar concepts are applicable here also.
Sure. I think this is well explained, and now this clarifies even one or two questions that we have already started receiving. We would also urge participants to write down your queries in Q&A box. We'll take it up towards the tail end of the session. So the next thought process, this is not a question, this is rather a thought process and understanding that many would like to have, is the reference segment, reference prices for this settlement is the prices discovered in a spot market across exchanges. Let it be across products, DAM, GDAM, or HP-DAM.
Yes.
Now,
Yes.
this short-term market is around 6 to 7% of, I mean, this question we raised even during the last interaction during for VPPAs. And this 7 to 6% market is again subject, the rates that are discovered are subject to a lot of other conditions like weather conditions or availability or unavailability of transmission corridors, or even nowadays a huge solar influx, which is, wherein the duck curve is visibly there, and there are few instances where we observed even near zero prices on the RTM segment on the weekends. Then how would you guide or what parameters that somebody has to take in mind who a participant who is from the electricity background trying to hedge the position? Of course, he will have certain idea about it. Somebody who is a retail investor or just having some traders or somebody who may not be exposed to these kind of things. How exactly, what are the guiding parameters to take certain positions here? Because I think that is something which will really help them to manage their risks more significantly.
Yes, yes. As you are as the electricity futures contract is referred to the day-ahead market prices, okay? And day-ahead market prices is basically meeting the last mile, near, I'll not say near, but at least a day ahead prior to whatever is the demand supply situation that someone anticipates. When we say anticipates, it is primarily the discoms who have to identify what is the demand supply position, and then based on that do the purchases for those specific 15-minute time block. Similarly, for the sell side entities, for the generators also, it is only the bare minimum delta or a quantum, okay, of power that could not be scheduled under different types of contracts. So when we say different types of contract, as everyone is aware, that at least 90% plus above of power is now today scheduled under the standard section 62 or section 63 PPA, which are running for 15, 20, 25 years, depending on type of technology. It is only the residual quantum of not more than 9% which comes in the short-term market. In this short-term market also nearly 2 to 3% goes under the either deep portal based purchases for maybe up to 1 month in advance or 2 months in advance or 3 months in advance or maybe few time blocks, and similarly on the exchanges also. So it's only the day-ahead market related one or the real-time market one where you are exposed to for a 24-hour market where there is no alternative that is available. Now, considering these factors, so when you are trading and trying to hedge for these factors, you need to also look into what is the total quantum that you have traded, maybe under the different market options for month ahead and day ahead. Take a call. Now, when you are taking a call regarding what is the price or anticipated, you need to look into what is the historical demand supply position that has been there for a given month. Okay. You also need to look into what is the different types of generation sources that are available for that given month or for that specific state's contracts that it has in place, in-state, intrastate, interstate, whatever it is, section 62, 63. What is the supply that is, what are the outages that are applicable? Whether there is any regional transmission outage which may affect price for a specific time block that needs to be anticipated. And also look into what is the agriculture supply division and also the weather changes or weather pattern that may persist during that specific period. Now today, in the month of August, I think it is after nearly 10 to 12 years that August has seen fairly good amount of rainfall when compared to at least previous 5 to 6 years. Similarly, whether the same season would persist in September or not is too early to say. But generally, September has the September heat or the October heat coming in. So there are few weather patterns that can be analyzed historically, and then a cue can be taken in that how day-ahead market price would vary during a month, and accordingly, a buy or a sell position can be taken at a specific number based on whatever is available currently.
Sure.
So good amount of analytics needs to be done by any entity
Yeah.
before he actually decides to take a long or a short position in the market.
Yes, and I think that is the underlying point because the one who is taking the position need to understand how physical markets really work in India, how the prices are discovered, what are the parameters that affect the rates discovered on the DAM or GDAM or HP DAM segments. And
Yes.
with this, a connected question, sir. So, any reflections? So I have started collating the questions in the Q&A box as well while we are discussing because there are few questions which are almost aligned with what notes I have to discuss with you. So the first coming from a very senior person in a sector asking this about any reflections on the settlement of last monthly trade in line with the underlying price methodology. How was it in lieu of forward price curve then versus actual? Any indicative observation on the size of derivative market reached vis-a-vis spot market? So that is something coming from someone who is following this discussion since beginning. And I think the complementary question I had is to what extent can derivatives really complement existing spot RTM and DAM markets?
Yeah, let me just go through the numbers that I have. Okay.
Sure.
And that will help us out to address your specific query.
Sure.
Okay, the NSE commenced electricity futures trading from 14th of July. Okay, and trading happens from Monday to Friday. We have had 5 weeks of electricity futures trading. And in this, at least till previous Friday, which was, okay, since it is Monday to Friday, 15th August was on Friday. So the previous week, trading week got closed on 14th of August. Till 14th of August, nearly 83,539 lots of electricity got traded in the futures market. So when we say 83,539, what it means is, and since each lot is 50 megawatt hour, the total quantum traded is 4,177 MUs over 24 sessions. So 5 weeks, the previous week had only 4 days. So it is 24 sessions. We have had trading of about 4,177 MUs. So on an average, nearly 170 MUs per day is what is the numbers that we can look at when we correlate lots with the physical trading volume. So this is 0.8 times the day at market volume. So day at market volume, both conventional, green, high price, if you combine all three platforms, it is about nearly 200 MUs. So it has reached to about 0.174. And the total turnover of volumes that are got traded. So when we say volume 883,539, and one more element is basically there is an average price across all these 24 sessions is somewhere about 4,333 rupees per megawatt hour. So in paisa it would be or in per unit it will be 4.33 rupees, 4 rupees 33 paisa per unit. Now, when we consider what is the total physical energy that has been traded in the electricity futures or electricity that is traded in futures and the average price, the turnover is somewhere about 1,815 crores. So this is the number-wise significance that can be taken from the past 5 weeks of trading.
Okay, sure. There is a question coming from Mr. Pratik Bhandari, who is a counsel from Khetan and Company. With derivative trading now permitted on power exchange or exchanges and VPPAs being introduced, he would like to understand your perspective. Do you see both instruments developing successfully in parallel? Will they operate in complementary manner, or is one likely to outpace the other in terms of market adoption?
Okay. I'll require indulgence for at least 2 to 3 minutes on this specific topic because we are referring to a VPPA which has already been covered in your earlier webinar. So
Yeah.
I'll request more time on that also. And how does that relate with this? When we look at CRC's guideline that has come in and for which public hearing was done on 18th, CRC says that VPPA will be an instrument, okay, wherein the objective, what is written, I'm not referring to what is given in the guidelines, is the VPPA will be an instrument which will primarily allow a consumer to receive or continue receiving power from its existing DISCOM, okay? But however, he will be allowed to get the ESG benefits by contracting green power from an entity which has either set up a developed-based plant, maybe in state, outside state, or interstate. So that's out. Now, when it comes to VPPA, it also refers to an adjustment that may happen between a strike price, which you call it as a VPPA price, or a market price. And market price, as per the guideline, it refers to maybe day-ahead market or real-time market. If we extend that to all products on the exchanges, so what it means is you have a daily market price which comes in, you may have a monthly price which comes in, and then you also have a strike price which is entered between both the entities, both the consumer and the generating entities. Now, there is some financial settlement element which needs to come in. Since there is no settlement as per guidelines which is available under the CRCs, so this settlement can never happen on the power exchange platform. However, when it comes to commodity exchanges like NSE, yes, they are the right instrument and the right place at which VPPS can run in. Why? Because VPPA requires a financial settlement. The energy that is being sold by the generator will receive a commercial settlement from the power exchanges. However, for the settlement between the VPPA price and the price at which the power has been contracted, there is a financial settlement which needs to happen. Now, this settlement can be handled only by a entity that has capability to do it. And capability means you need to have a right set of clearing corporation which is able to handle this data, and no better than NSE itself, because NSE has the largest clearing corporation in India And when it look at transaction wise, since the NSE has the largest transactions in the derivatives market all over the world, the clearing and settlement system through its clearing corporation is the most suited entity which can do the clearing for this. So when it comes to VPPA, yes, it will get replicated on the electricity derivatives platforms like NSE, and NSE has in the process of seeking approvals for new contracts, which could be quarterly, monthly is already introduced, quarterly for up to 2 years, and yearly. Along with that, CFD as and when the approvals are issued by CRC for the VPPA guidelines.
Sure, I think that answers the query, I believe.
Yes.
Now there is a question that I am little, the question itself is speculative. And so is there any danger that electricity derivatives, not immediately, maybe in a future course of time, could lead to price manipulation and volatility as that has been observed in global markets in the past?
Yeah, to clear the haze regarding how electricity futures operate and what could be the after effects. World over, wherever electricity futures have been introduced, they have led to reduction in volatility. They have also led to stabilizing the wholesale prices, and also the electricity futures have provided price signals for future investments. Now, worldwide, when we say in mature markets like EPEX, which is handled in Germany and also in Europe, and also the Nord Pool, the electricity futures market have been running for decades. When it comes to Nord Pool, they started way back in 1990s, and they have at least 3 decades of experience. Similarly, in EU also, yes, it's more than a decade of electricity futures introduction. Over there, the trading in futures is at least 3x of the physical market. And the trading in futures has actually reduced the volatility, stabilized the wholesale prices, and it has provided price signals for future investors. So as the tenure of the monthly contracts or the electricity futures contract increases, today we have only up to month, and NSE actually has approval up to 12 months ahead. But however, they have immediately started only with 3 months, because that replicates with what is available on the power exchange platform, which is up to 3 months ahead. Since the portal already has up to 1 year, okay. So shortly they would be opening up for next 12 months itself outrightly, wherein you will have 12 monthly futures contract. And as the trading increases, now this August will be the first month wherein future settlement will happen. In July, there was no future settlement which happened for the 14-day period, because July was only mark-to-market settlement which happened on day-to-day basis. August will have the first news. There are good number of grid connected entities which have already hedged in the futures market for the month of August, and this is likely to increase for next future months. So considering the volumes which are increasing, we expect a 12-month calendar, quarterly calendar, and also newer products like CFDs to come in. So it's given that more the products, more the visibility, it will lead to reduction in volatility and stabilize the prices.
Sure, and I think the counterbalance or checks that have been put in place inherently through the product specification in itself, I think they will also try to address a lot of
Yes. To address that, SEBI has clearly said that the day-to-day limits would not be more than 9%, which is what the circular clearly says. So that's how it is.
And sir, the most talked question since, and I'm getting a lot of pings other than the Zoom platform to please float this question, that how market coupling in Indian context would really reflect underlying price of electricity for products on the commodity exchanges. So
I don't see any reference to be given to market coupling for electricity derivatives. Why? Because NSE's electricity derivative has already taken a common weighted average price number by considering the trade that happens in all three segments: green, conventional, high price, and in all the three platforms. So going forward also, since market coupling would have the same element of discovering prices for all three segments, I think that's already taken care. NSE's electricity futures reference has already taken care of the combined volume and the combined segment. So that's already addressed.
Yeah, I mean, yes, while I can understand, NSE has really addressed these issues. At the same time, the other contract which is being offered on MCX, I guess that refers to the DAM segment on IEX platform or specific one platform. And there may be this question or concerns around this question may be relevant. How exactly it is going to impact the product that is available on the other platform. And this I'll like to take one or two more questions that are there in the Q&A box. Yes, so there is a question again. We may treat it as there was answer to this question during the discussion, but if you can just address it again for the benefit of audience, that can you please shed some light on how daily mark-to-market settlement and then eventually post-expiry settlement is done? So, I mean, how exactly the realization will happen for the participants in this segment?
Yes, yes. Now, what happens in a derivatives is you have a daily mark-to-market settlement. Why? Because since there are uh, since there are no preconditions for entry and also no preconditions for exit. Now, when I say preconditions, like it is equivalent when you take a corollary from the physical market. In the physical market, you have preconditions like NOC. So unless you have an NOC from the SLDC of the state saying that the NOC is to buy power, okay? So for that specific time block, you cannot actually sell power. So if NOC is for buy, then you can only receive power or consume power for that 15-minute time block. And similarly on the sell side also. So unless an NOC specifically says that there is a X quantum for buy and a Y quantum for sell, okay? So for any given time block, there are preconditions. However, in case of electricity futures, there are no preconditions like whether there is any limits in terms of who can enter or who cannot enter, okay? And since this is a standardized contract which has the ability to change the position, okay? So you can actually square off the position. So on day-to-day basis, in case you feel that it is whatever position you are taken is likely to be adverse, maybe at the end of the day or on the continuous basis from time to time, okay? You can square off that, or else if you feel that there is a gain or a loss to be done, that can be limited based on day-to-day changes that happen. Like suppose today is Wednesday, and if hypothetically speaking, if the closing price for today is 4,000 rupees, or you have entered at 4,000 rupees today, and if the closing price for that is 4,050 based on whatever contracts that get traded, and if the closing price is 4,050, the entity that has bought futures will have a gain of 50 rupees. And the entity which has sold futures will have a loss of 50 rupees. So on daily basis, whatever change is happening, till you square off your position, there will be a mark-to-market settlement which will happen. In case you continue and you remain vested in the contract till it expires. Now, since every monthly contract has an expiry date, so for the month of August, last trading day is considered as 29th of August, which falls on maybe a Friday. So the settlement will happen on 31st, considering all 31 days. So any open positions that remain, continue to remain before square off, will go for a final settlement, which is the simple average of all 31 days of the weighted average price for each day. So both the concepts are there. You have a day-to-day gain or profit based on day-to-day settlement price and a monthly expiry based due date rate.
Sure. I think that clarifies. Another is coming more of a regulatory stuff that there are two connected questions. So currently we have financially settled products. What is the right state of market to see forwards with physically delivery based products? And there is another one is, does the resolution of SEBI CRC jurisdiction dispute also means that forwards can also be introduced on the bilateral OTC market soon, in addition to standardized futures on the exchanges?
The judgment of Supreme Court is very clear that if someone wants to physically trade power, where there is delivery of power, it will be necessarily regulated by CRC. And if it is a cash settled contract, it will be necessarily regulated by SEBI. So we don't expect the power exchange and commodity exchange to have cross contracts. Okay. So if it is physical delivery based, it will always be on power exchanges. If it is cash settled futures contract, it will always be on SEBI regulated, which is NSE's commodity platform. So that's how it will be. That's the simple answer for that.
Yeah, just to extend it, does it also open the window for power exchanges offering physical delivery contracts to offer forwards?
If power exchanges intend to have electricity futures contract, it will have to seek approval from SEBI. So unless a power exchange decides to take an approval from SEBI, electricity futures contracts are ruled out.
Sure, I think that is a critical and very precise answer here. I think that addresses another query, and I think VPPA we have addressed. Settlement we have addressed. Sorry, I'm taking another moment to just collate so that I don't miss out on any of the questions. Jurisdiction is done. Buyer killer sense in terms of commodity through virtual market will influence on the actual physical market. I think we discussed about the influence of possibility of influence of these markets on the discovery of prices on the exchanges, because it is to address the volatility, and in long term it may definitely help address that. Now another question is coming, while it has been partially answered through a lot of questions that we tried to elaborate here, but here it is coming about the discoms. Now we talked about how liquidity on the physical segment, what is its state right now. So what value proposition could discoms get in hedging the volatility of prices in DAM market? Because discoms and generators are the major market makers in the segment.
Yes. And since electricity derivative is a pure hedge instrument, okay, the largest players, whether it is a generating plant which is selling power, okay, or a discom which is buying power, whatever contract that it enters into physical market, it needs to hedge this price of transaction. Why? Because as a buying entity for a discom, if it takes a futures position, okay, anticipating increase in power purchase cost, okay, anticipating increase in power purchase cost. Like today, if you have purchased a futures contract, I go back to the same example of 4,000 rupees is what is the current market price. You anticipate increase in prices for the month of September. So you purchase a futures contract at 5,000 rupees, which is in case of discom. Okay. Now what happens is, since there is a day-to-day price which is referred to settle the monthly futures contract for a discom which is purchasing power for the complete September month. So it means all 30 days, all 24 hours. So there is some megawatt, there is some units of trading lots of six. Okay. The settlement price of the monthly futures will be based on the weighted volume average price, okay, for all 30 days. So since weighted volume average price for all 30 days is available, okay, if the price increases to maybe 5,200, 5,500 or 6,000 rupees, okay, he has purchased 5,000 rupees. His physical procurement will happen at 5,200, 5,300 or 6,000 rupees. But there is a gain of this incremental 200 rupees, 300 rupees, 400 rupees, or maybe 1,000 rupees if the price is 6,000 rupees from the futures market. So his effective purchase price will be 5,000 rupees, because if the settlement price is at 6,000, he has purchased the electricity futures at 5,000. The expiry rate for that contract will be 6,000. He gains 1,000 rupees from that. He purchases physical power at 6,000 rupees. His gain is 1,000 rupees from futures market, and his effective purchase price will be at 5,000. So this is how the benefits of electricity futures hedging can be gained by DISCOM. So it is in anticipation of price rise. So he has to take a long position in the futures market.
Sure. I think this well explains. And I'll just take this final question here, as we are moving towards the closure. Uh, can we expect, with more and more renewables coming into picture and the volatilities that we are observing around solar prices during the daytime, can we expect some time of usage specific contracts in this segment in future, near future, maybe peak contracts or something similar to that, where people will be more focused and uh, they will be able to gauge or relate to the physical segment more with availability of such contracts?
Yes, these are early days, because when we commenced, or when NSE commenced introduction of electricity futures, they have considered base load contracts. That's how worldwide also it starts with, that you initially consider the base load contracts, build the minimum liquidity in the base load contracts, and then you address the specifics related to, in this case, it is peak contracts. Okay. When we look at Nord Pool, yes, Nord Pool has both base load contracts and also peak contracts. And those peak contracts could be for weekend or weekly also, or maybe for monthly also. So when you say peak contracts, it is considering the reference price for those peak hours of the day, and then arrive at what is the futures peak contract. So similar thing can be expected going forward, but these are too early days. Let us see how it pans out. Let us increase more and more number of grid participants into this, and then that call can be taken. Yes, periodic contracts are likely, the tenure of periodic contracts is likely to increase. So from 3 months ahead, 12 months ahead, they have approval. So they may launch it based on the amount of traction that is coming in. NSE is also looking into quarterly contracts. So 7 quarterly ahead. So nearly 2 years, and then followed by yearly contracts, which could be approved for at least 5 years. So this is what they envisage, right?
Right. And with this question, we come to the end point of this discussion. And unlike last 6 sessions where we engaged into panel discussions for our specific topics, we purposely kept it more focused so that audience get an opportunity to dive into the fundamentals of this contract, which is newly introduced. Of course, there are more and more capacity building sessions that are happening around, and people are trying to understand the product in details. I think this was an attempt to discuss the fundamentals and address the queries. We would definitely love to arrange a panel discussion, maybe in immediate future course for our next sessions, to further deep dive into the nuances of these contracts that are, and how it really present an opportunity for the stakeholders. So today we had a consistent 85 plus participants attending this session, patiently listening, asking questions, interacting. And this is really encouraging for us for having the monthly session. I'll then go back to Aditi, and Aditi, for your final remarks. And after that, maybe quickly to Anil sir for his final words before we close.
Thank you, Nikhil, and thank you, Mr. Anil. As we come to the end of the session, I would like to take a moment to thank our MD, Mr. Vinayak Varimbe, who has been a constant support and encouragement to all our work, various initiatives, for his guidance and consent in driving such small contributive work that we do for this segment. Thank you very much to Mr. Anil for sparing his time. It is invaluable to have you at the forum. It was great to have these insights straight from you. And thanks to Nikhil for driving it so very well. Thank you very much to all of our participants. You have been very proactive, interactive, sending us so many questions. And thank you for listening, staying with us throughout the session. We invite you to our next session, which these sessions we do every month, and we'll shortly share the details with all of you. So thank you very much for being with us. Thank you once again to everyone.